This is Chris Evans, and this is part one of an analysis of oscillators. The ultimate objective by the time I get to part three will be to find an oscillator that does work and has some value. But to start out, I'm going to look at generic oscillators. And in this chart, you can see I put three in here. The RSI, the stochastic, and the detrended price oscillator all apply to the S&P 500. And in every case, they really behave quite similarly. You can see that they all move up to this overbought level, and during a trend, they stay overbought for the entire trend. During a period of chop or a period of range trading, they have an ability to make money. You can see the entry point here in the stochastic was a good one, getting you in the market at this low, and it apparently got you short at that top. That looks attractive. The RSI is failing here to get above the overbought level, so never got you out. But in general, they do behave very similarly. And in this case, both cases, I'm using a 14-day look-back period. Now, there's two ways of actually generating signals. One is to look for the market to become overbought and then to sell it. The other one is to look for it to cross back below the overbought level before we take the trade. You can see here it crossed back below the level here, which failed, and here it crossed below here, and it succeeded. The question is that indicative of how it worked over a 20-year period? Let's look at the results here. Here's a system using variations away from a mean of 50. This is a 50 is a neutral level for RSI. And I'm going to study its variation away from that level in terms of standard deviation movements. A full standard deviation away from the 50 is obviously a significant move before the oscillator becomes overbought and then generates a signal. In this system, such as I have it defined right now, I have 3/4 of one standard deviation move will generate a signal, and a 14-day look-back period is set, and this is the performance, and the performance is completely unacceptable. Now, if I allow the standard deviation movement to vary between 0 and 1.5 standard deviations, which I'll do right now, I'm going to leave the look-back period at 14 days. I just want to eliminate this from something that anyone ever looks at again on their screen. You can see that between 0 and 1.5 standard deviation movements, there is not a single profitable solution for a 14-day RSI going back 20 years. Not one. Here's the best solution is a 0.1 variation away from 50. And the performance chart looks like that. So what if I change, or what if I allow the look-back period to vary between 5 and 14 days? And I also allow the standard deviation to vary between 0 and 1.5 standard deviations, just to see if there are more solutions that work that we're just not aware of, that maybe we should reset our presets and our look-backs when we put an RSI on our chart. And out of 160 iterations, it found about 10 that were profitable, 10 out of 160. And the favorite look-back period seems to be 5. So let's just look at a plot of the best solution. Now again, you've really got a system here that makes money rarely. But it made money in the same period, this 98 to 01 NASDAQ bubble period. And it made some money here in this 05, 07 period. Other than that, this is not a system we would trade. What about if we waited for crossovers to occur before we took a trade? Well, I've labeled that, changed the signal to 1, and then everything else stays. The other possibilities remain the same. We still get 160 iterations, but this time I'm not going to sell it when it gets overbought. I'm going to wait till it gets overbought and then crosses below that overbought level. Then I take the trade. How much better did that work? Well, it works better is the answer. You get about 30 different outcomes that are profitable, 30 out of 160 iterations. So that's a significant improvement. The oscillator length that's preferred now becomes 11 or 12, something longer in this zone than the 5 that are preferred in the other structure. So if I pick 10, which is something in the middle, 0.2 standard deviations away from the neutral level is what it wants. And we can look and see how this performance is. And again, we have a system here that does make money during somewhat gentle low volatility periods, but during trends is a significant problem. It's better, but it's certainly a long way away from what we want it to be. And the problem is when you're looking for reversion of a trend, which is what RSI is really doing, it's saying, I want the market to go back to doing what it was recently doing. I'm looking for these small pullbacks here to get in and let market resume a rally. I'm looking to get short here on the resumption that that downtrend will continue. We could add a screen. We could add a moving average screen and see if that helps us, and that's what we'll do next time.